Buy and hold. Lame. Day trading. Oh, everyone knows buy and hold for long terms like Warren Buffett is lame. Everyone needs to be day trading. If you're not day trading, you're only losing money. Oh, obviously, this is a stupid meme. And there's my stupid face. All right, guys. So, how to start with that? We always got to start off with a meme if we can, just to make finance a little bit more fun. Because let's be real, finance is boring as hell. Hi, guys. This is Chris with Leveling Up Your Finances. And today we're going back to the basics and how to invest in stocks. This is a guide from Forbes Advisor. They're the money man, smart people. Unlike me, I'm just an idiot on YouTube, so don't take any of my word for any of this. So do whatever they say or something. But I'm going to still give you my opinions on things. So since we're going back to the basics, we're going to start off with stocks because most of the time when you're learning about investing, you're learning about stocks first. That's generally most people started their investment careers off with buying stocks or bonds. Historically, the return on equity investments has outpaced many other assets, making them a powerful tool for those looking to grow their wealth. All right, guys, so there's different ways you can invest in stocks. You can really how you want to buy stocks depends on your investment goals and how actively involved you want to be in managing your portfolio. So if you really want to do deep dives on companies, you can do individual stocks. If you want to be lazy like me, I mostly only do ETFs now. I used to do a lot of individual stocks. And then if you want to be like Dave Ramsey lazy, you want to do mutual funds, which we'll talk about it. Nobody does mutual funds anymore. But you can also get like an advisor, robo-advisors, all sorts of stuff. So you really want to sit down and think about your goals. How long of a timeline do you have before you need to use this money? And then also your risk tolerance. There's a bunch of little things you want to think about, and then that'll help you decide how you want to go. So if you want to invest in individual stocks, if you really enjoy research and reading about markets, companies, buying individual stocks might be a great way for you. That's how I started out, and I think that's how most people start out. Nowadays, you can do things like ETFs, which makes it so much easier. So if you want to be lazy and not actually deep dive into companies, you can totally do that. However, I still recommend you do it somewhat. Know what you're buying at least. Um, Even if the share prices of some companies are pretty high, you can always buy fractional shares as well. And then you can start out by only or with an only modest amount of money. And this is great now. If you didn't know, most places let you buy fractional shares. When I was starting out, that wasn't an option. The first one to ever let you was M1 Finance, and I still have my M1 Finance accounts because of that. It was great because if you're buying something like Apple or Amazon now, even with the splits and stuff, they're still very expensive, and some people can only, I don't know, put $10 a month, $100 a month. Like you can't just go out and just buy a straight share with that. So that's obviously an option for you. Again, if you are going to do individual stocks, I don't recommend a very large amount, maybe say 5% in each individual stock. Don't go over that really because at that point it gets kind of risky. Do whatever you want, guys. I mean, you guys know what you're doing. I hope. So another one, you can invest in ETFs. I definitely recommend this for beginners. We didn't really have these when I started. When I did get my Schwab account, though, at least, what was this, about 10 years ago, I only invested in ETFs just because, again, I was an idiot and it was smart and it was easy. And they did all the work for me in a sense. And I didn't have to pay commissions for a lot of their accounts or their ETFs, which was great because back then you had to pay commissions on everything. So exchange traded funds, also known as ETFs, buy many individual stocks to track the underlying index. When you invest in an ETF, it's like buying stocks from a very broad selection of companies that are in the same sector or comprised a stock index like the S&P 500. The one I always buy and I still buy today is VU because it just tracks the S&P 500. It's an index ETF. It just tracks the S&P 500 index, which we'll talk about too. ETFs shares trade just like any other stocks on the exchange, but they provide a greater diversification than only owning just an individual stock. So instead of putting all your eggs in one basket, now you're putting in, spreading your eggs out and investing in multiple companies at once. 3, you can invest in mutual funds. Let's be real, nobody invests in mutual funds anymore. But if you're old school, mutual funds were basically ETFs back in the day with more fees, and you could only buy at the beginning of the day or the end of the day or some weird stuff like that. I haven't owned a mutual fund in like 15 years. They're not necessary. But mutual funds share similar as ETFs, but there are important differences. Actively managed mutual funds have managers that pick out stocks in an attempt to beat the benchmark index. When you buy a share of a stock mutual fund, your profits come from dividends, interest income, and capital gains. So lower cost index funds are mutual funds that work more like ETFs. That's not entirely accurate. Not all index funds are mutual funds. Most of them are ETFs. Again, VU is a classic example. It's an ETF. It's not a mutual fund. And I'm very heavy in VU. Most of my actual portfolio is in VU. So that's my disclaimer. If you want to go do it, do it. Buy it. I don't care. But keep in mind, there's no right or wrong way to invest in stocks. Yeah, the wrong way is investing in mutual funds. And also the wrong way is when you lose money. All right, Forbes, you need to get up to speed. All right, guys. So jokes aside, how do you want to invest in stocks? There's a variety of accounts and platforms you can use out there. You can buy stocks via yourself. That's what I choose to do. It wasn't always like that, but again, once you kind of know what you're doing, you can always do it yourself via an online broker. Or you can hire a financial advisor if you're a beginner or you have a lot of money that you need to have someone manage, basically. That's always an option. Or you can use a robo-advisor to buy them for you. I've had one robo-advisor. It wasn't too bad. It was Schwab's when it first started out, but I haven't used it in, I don't know, 8 years. So that's up to you. There's a bunch out there. And if you want to just hands-off approach, it might be a great way for you. I think like something like Acorns is still considered a robo-advisor. I don't even know if Acorns is around anymore, but I had that even at one point. The best method will be the one that aligns with how much effort and guidance you would like to invest in the process of managing your investment. So again, that goes back to your goals and what you're going to do. But to get started, you're going to open a brokerage account. If you have a basic understanding of investing, and you can open a brokerage account and buy stocks. Our brokerage accounts puts you in the driver's seat when it comes to choosing and purchasing stocks. Hire a financial advisor. If you prefer to have more advice and guidance for buying stocks and other financial goals, consider hiring a financial advisor. And remember, it's not always about stocks. It could be about like estate planning. Financial advisors can do a lot of stuff. They can help you specify your financial goals and help you purchase and manage your investments for you, including buying stocks. Just be note that financial advisors do charge a fee. It can either be a flat annual fee, a per trade, or percentage of assets they manage. You want to go with the flat annual fee if possible. If they're doing per trade or a percentage of your assets, they can, I don't know, manipulate it in a way so they get a bigger commission, if that makes sense. Not all of them are like that. I'm just saying it's your money, be smart. I'd go with the flat annual fee. You could choose a robo-advisor if you like. They're very simple, very inexpensive way to invest in stocks. Most robo-advisors invest money in a different portfolio or ETFs, and they buy the assets and manage the portfolio for you. They are generally less expensive than financial advisors, but you seldom have the benefit of a live human to answer questions and choose for you. Yeah, basically, most of them are going to ask you a bunch of questions, and then they're going to invest in a portfolio that's pre-made based off of your answers and your risk tolerance. And then you can use a direct stock purchase plan. I've never heard about this really. I'm assuming you have to have a lot of money to do this, but you can buy stocks straight from the company themselves. If anyone has any info on that, definitely let me know. Comment down below and let us know. It seems like a great option, but I don't know. It seems like a lot of work too, though. So I don't know. Never done it. Never really looked into it because I didn't even know it was an option until recently. So keep in mind that no matter the method you choose to invest in stocks, you'll most likely pay fees at some point to buy or sell stocks or for an account management. Pay attention to fees and expense ratios on both mutual funds and ETFs. But you're going to say, but Chris, Robinhood doesn't charge me any fees. Yes, they do. They charge you part of the spread and you just don't know it. And eventually that actually adds up more than commissions are anyways. But yes, a lot of accounts don't charge the commissions anymore. That was a big one. When I started, I was super annoyed because you always lost like $10 on the buy and or the sell. And then they dropped it to $5. That was really awesome, Schwab. But I don't use your accounts anymore anyways because I'd rather do free stuff like Robinhood. Joke. That was a joke. All right, accounts to invest in stocks. If you're very first starting out, you might want to start with a retirement account. I think that's the best thing because eventually someday you will retire and or need money when you're old and you cannot work. So start off with a retirement account. Plus there's tax advantages to it. The two most common types out there are the 401k and then individual retirement account, also known as IRA, individual retirement accounts. 401ks, though, are only available from your employer, while basically anyone can open an IRA with online brokerages or robo-advisors. Again, these accounts offer tax advantages. That's the incentive to you to save for retirement, but they also come with annual contribution limits. Other retirement accounts include 401, these ones right here. So again, a lot of them are either taxed before or deferred taxes later. Basically, when you're buying and selling in these accounts, you're not getting taxed at the time. You're going to get usually taxed when you're pulling the money out, but it depends on the setup you have. Again, 401ks are from an actual employer, and sometimes they have employer matches, and then IRAs are something that you can open on your own. Taxable investment accounts. So this is like the Robinhoods, the N1 Finances, the accounts that you basically do yourself kind of thing. Proceeds from the stock investments make it a taxable investment. Accounts are treated as regular income with no special tax treatment, plus there are no contribution limits. So say you're selling on your Robinhood and you decide that you're going to day trade because you're stupid. Even if you make money, guess what? Every time you profit, you got to pay taxes on it at the end of the year. So just keep that in mind. Versus again, if you're in a sense day trading or swing trading in IRAs, depending if you can, because some of these accounts are crazy and you can do the same thing, it's not taxable again until you pull the money out. And then they have things like education savings account. These are like the 529 plans. These are kind of going away. I don't see them in the future, so I never opened them up for my kids, even though I deep dived into it a while ago. I basically have them in a taxable account, which again isn't the best because it's taxed. Hello. But it's the easiest and I have more control over it, so that's what I do. Both my kids have investment accounts. Granted, it's in my name, but whatever. I still put money in it weekly for both of them. And that's what I'm doing. So instead of a 529, but you don't have to do that. That's just what I'm doing. Do whatever you want. So how are you going to fund your account? If you plan on buying stocks via a retirement account like an IRA, you may want to consider establishing a monthly recurring deposit. Yep. Just set it and forget it. Ideally 10% or 15% of your paycheck goes into your retirement account. Some people can only start off with 1%. Whatever it is, just set it, forget it, and don't touch that money. Just let it do it every single, 2 weeks, every month, depending on whenever you get paid. For example, 2020, this is the same contribution limit as now. For an IRA, you can put in $6,000 a year for anyone below the age of 50. If you're over the age of 50, you can do a catch-up, $1,000, so you can get about $7,000. If your goal is to max out your contribution for the year, you may want to set recurring deposits of $500 per month to meet the max limit. So there you go. It may be $250 per check, $500 per month, whatever it is. That way you get the $6,000. Even if you can't, again, I recommend even if it's $50 a month, definitely start a retirement account over anything else. It's just the smart way and the best way to optimize your money. But you can't touch it until you're ready to retire. Basically, there's ways around that as well. It gets complicated, whatever. If you're buying stocks through an employer-sponsored retirement plan like a 401k, you need to indicate what percentage of your pay or flat dollar amount you want to be deducted from each paycheck. And again, a lot of 401ks, employers still do 401k matches, say like 1% to 5%. So if your employer is going to give you a 5% match, you might as well contribute at least 5% because that's doubling your money without even trying. Does that make sense? So whatever the match is, definitely do it if you can. I know we're living in crazy times and no one has extra money because inflation is awesome. For all the other types of investment accounts, establish a clear investment goals and then decide on how much of your monthly budget you want to invest in stocks. So what the amount you feel comfortable losing every month or getting tied up, you got to think about those things. If you don't have money for an emergency, maybe you shouldn't be investing in stocks right now. Things happen. Sometimes you got to pull back. Sometimes you can add more. That's just how it is. If you get a commission check, you might want to invest more of it. Again, those come back to your individual goals. You can choose to move funds into your account manually or set up recurring deposits to keep stocks investment goals on track. I have to do the automatic because if I don't, I will not manually do it. I'm very busy, so I have to just set it and forget it. Otherwise, it will never get done. And then here's some other things to consider. Mutual fund a lot of times they have purchase minimums. Again, no one really does this, but you can read it real quick. Morningstar, I haven't looked at that forever, but it'll help you find ones with 0 to low minimum starts. Again, a lot of accounts have trading commissions. Most of those have gone away. They say it's free, but a lot of times they're taking off the spread. And then mutual fund fees. So those are something you might want to consider, but you can just read over those really quick. There's no point in going into it because most of it doesn't apply anymore. All right, start investing in stocks. Select the individual stocks, ETFs, or mutual funds that align with your investment percentage and start investing. If you choose to work with a robo-advisor, the system will invest your desired amount into a pre-planned portfolio that matches your goals. Exactly. They're going to ask you a bunch of questions, and then they're going to figure it out for you. If you go with a financial advisor, they'll buy stocks and funds for you after discussing it with you as well. On the execution of your orders, the securities will be in your account, and then you can enjoy the rewards of the stock market. And yes, your funds will reap dividends and experience losses and the economy changes. But for the long term, you want to be taking part in the sector of investment that will help you investors grow their wealth for over a century. So again, yes, right now we are in a recession. We are in a bear market. A lot of people have lost money, but remember, you only lose money when you sell. Investment is a long-term. Most people are trying to get rich now, quick. It's a long-term game, so be smart. And then even if your portfolio goes down 10%, don't fret. Just kind of wait it out, that kind of thing, guys. So I know it can be emotional for when people first start out. Eventually, you'll be a hardened diamond hands like everyone. All right. Also, you want to consider a dividends reinvestment plan. So it's called DRIP. It's basically your dividends come in and then you just reinvest it automatically. Definitely recommend that, especially in your taxable accounts, because I think you have to, in your other brokerage accounts. Unless you need the money for whatever reason for income, just do DRIP. It just does it automatically for you. Keep a note, though, if it's in a taxable account, you will get taxed on your dividends that come in, but it's so small it usually does not matter until you have a large sum of money. Reinvestment plans take the dividends you earn from individual stocks, mutual funds, or ETFs and automatically buys more shares of the funds or stocks you own. So here's another one you might want to consider is rebalancing and checking in on your portfolio. Rebalancing helps ensure your portfolio stays balanced with a mix of stocks that are appropriate for your risk tolerance and financial goals. Market swings can unbalance your asset mix, so regular check-ins can help you make incremental trades to keep your portfolio in order. There is no need to check on your portfolio daily, monthly, or quarterly. Schedule is a good cadence. So usually just check in monthly or quarterly, depending on what you're doing, especially if you set it and forget it like me. It's just easy. You don't have the daily swings, the weekly swings. You don't have to worry about any of that. There's no extra emotion or panic. So yeah, you kind of want to rebalance your portfolio. Eventually it gets to the part where you can't, especially if you do things like cryptocurrency. My portfolio is pretty much out of whack, but I'm not selling my crypto right now, especially with it being down. But yeah, it just happens. And at least take note of where you're at and how it's going. But again, do it monthly or quarterly. And again, a reminder, investing in stocks is a long-term effort and you will experience inevitable swings as the economy goes through these usual cycles. And that's where we're at right now, guys. It is a bear market. A lot of people are down, but again, you don't lose until you sell. Once you sell, that's when you lock in those losses. And you can probably just wait out for the next few months to couple years when we go back into a bull cycle, and you'll be like, why did I sell? So those are my advice for you on that. If you have any comments or anything, comment down below and let me know. If you want me to cover anything, comment down below, let me know. If you think I'm an idiot, write idiot down in the comments below, and I appreciate that. At the end of the day, guys, remember to stay awesome and keep loving each other like I love mutual funds. Okay, that's probably a bad example.